Coming up in today's show, stocks finish on a soft note after a surprise uptick in inflation, how that could complicate the Fed's job. We'll take a look at the Bitcoin ETFs listed today and what it could mean next for the industry. More drama in the Middle East with Iran seizing an oil tanker, and Microsoft briefly becomes the most valuable company today. Welcome to the Click Capital Daily Market Show, everybody. I'm your host, Jared, and if you're an active trader or investor, stay tuned, as I'm going to give you a curation of the best financial content, along with some data and technical analysis of the charts, to get you all up to date on everything that's happening across financial markets, so that we can all make better decisions in our portfolios. And if you haven't already, hit that subscribe button, as I make these shows every day after market close. And so it was a bit of a mixed day today. The big one was CPI inflation coming in more than expected, which bond markets didn't really react too hard to, although we did see a sell-off in the yield-sensitive utility sector. Mega cap tech was kind of flat. We did see Tesla fall off after car rental company Hertz said they're going to sell their 20,000 Teslas and replace them with gas-powered cars. Other than that, it was pretty checkered breadth across the board. Just looking at the S&P 500, we did take out those highs from late last year at 47.93. We got up to 47.98, just shy of 4,800. All-time highs are at 48.18, just above this resistance box here, which the market is looking primed to do. Just taking down to the 5-minute chart on the SPY. We initially sold off in the morning after first gapping up, but then we found support around lunchtime and have bounced back, which has given us that bit of a hammer formation on the chart here. Same deal with the Nasdaq, and the Magnificent 7 broke out to fresh highs as well. Yields actually sold off today. We've got the 2-year down to 4.25. Bonds are not interpreting this latest CPI report as making the Fed likely to stay on pause any longer than what they previously thought. Still forecasting the Fed will cut in March. But stick with me because I'll come back to the charts later on. So the year-over-year inflation rate was expected to come in at 3.2%. Actually came in a little bit higher at 3.4% for the month of December, and that's an uptick from the month of November, which was 3.1%. Same with month-over-month increase. Bit higher than expected and higher again than what we got in November. So there's a monthly line chart of the year-over-year inflation rate, currently at 3.4%. That's come off that big peak in June 2022 of 9.1%. However, it could potentially have found a bit of a bottom here at 3%, or at the very least, the trend has slowed down, it's stalling out, consolidating. The market still thinks it's on its way down to 2%. However, it's kind of a similar pattern to that of 50 years ago in late 1972, early 1973. Got that initial wave higher for the first time in many years, then it pulled back, and the trend kind of stalled out for a bit before it went on to make another big second wave higher over the next 2 years to above 12%. Then once again it came rocking down in a strong persistent downtrend, found a pretty quick bottom, and I'm sure a lot of people back then thought, gee, I'm glad that's over, that huge amount of crazy inflation most we had in decades. However, to many people's surprise, it went on to a third and even higher wave, reaching almost 15% in March 1980, before it then finally did come down back to central bank targets under 3%, and that was at a time of a generational low in the stock market, the early 1980s. And since then, inflation stayed pretty tame, getting a little high in the early 1990s, causing a recession, before going back down for the rest of the 90s, and staying pretty low going into the 2000s, giving a huge tailwind to both stocks and bonds. And so a lot of us in our trading and investing careers have pretty much only known low inflation and low interest rates, with the addition of Fed liquidity being huge structural tailwinds for equity and bond prices. However, now for the first time in many of our careers and 40 years, we've got inflation that broke out 2 years ago, and here we are today with a widely held consensus that it's going to keep going down to 2%, and the good times are here in the stock market. So if we were to see this number break out above 3.7 or even above 4% this year, that could really spook the markets and cause a massive repricing out there, probably most notably in stocks, especially high growth stocks, which you could kind of think of as long duration assets. And just like long duration bonds, they're more sensitive to changes in interest rates. So what's really helped inflation come down since it peaked in mid-22 was energy, crude oil mostly, and that's the biggest kind of volatile variable in inflation, and that can kind of lead other things, as it's a big input into other things like food. It's followed it down as well with a bit of a lag. So a key indicator for inflation is going to be the price of crude oil, which the good news is the US is pumping it out at record along with other non-OPEC countries, and there's still a bit of weak demand coming out of China, Japan and Europe. So as it stands, the price of crude shouldn't explode from here. However, we can't rule out things escalating in the Middle East, with OPEC still controlling half of the world's global crude supply, and so they're the biggest swing factor in the price of crude. And we've just seen that with Iran. Seems to be agitating the West a lot more by giving the green light to all their financially backed militant groups to come after our commercial container ships. And we've just seen them seize an oil tanker, and they're kind of poking back at the US and the West. And so that still has a risk of blowing over. And not only that, with risk assets trading up to highs, the US economy holding up pretty good, unemployment still really low. It could be a case of too much of a good thing. The economy does start roaring again. In the first half of this year, the rest of the world may catch up, and that increased demand could also get oil moving back up. Then maybe the second quarter or third quarter, CPI breaks out above 4%. Then the markets all of a sudden realize, hang on a minute, we thought inflation was done. It's not. The Fed may change its tune, then everything falls apart. So that's just a hypothetical scenario I'm speculating could happen, because quite often we see the market get surprised and a widely held consensus becomes wrong, just like it's done at the start of pretty much every year the last couple of years. Either way, the Biden administration and the Federal Reserve do not want to see oil keep going back up. They do not want to see CPI going back up. It's going to complicate their job, especially going into election year. They all want to stay in office. Not to mention the Treasury is forecast to have its biggest year of issuance ever, $4.6 trillion. It's more than 30% than what it issued last year. So the US government has to do a lot of refinancing and issuing new bonds to help pay for their budget deficit, because they spend a lot more than what they take in through tax. And so they would really prefer the 2-year, the 5-year, 10-year and 30-year bond yields as low as possible so they can refi at those low rates and keep the party going. And who knows, maybe that's what caused Jay Powell to do the big about face and pivot from hawkish to dovish. He may have got a signal from Washington to do that. And if that causes a bit of an uptick in inflation, well then so be it. They'll deal with that later on. And that could be why, even though we got a bit of an uptick in CPI and inflation, the market's still pricing in about a 75% chance the Fed's going to cut in March and cut again in May and pretty much every meeting for the rest of the year. And so don't you think it's a little strange with risk assets at highs, unemployment at record lows, nothing really breaking out there, core inflation rate still just below 4%. That's almost double the Fed's target of 2%. And then we're looking like we're going to start cutting rates in 2 months. Some people are saying the Fed's got to cut to ensure a soft landing, get ahead of a recession. However, I think it's also very politically convenient going into an election year and for the Treasury and US government to refi their debt at the lowest rates possible and then deal with some inflation after that. So if that were to happen, the economy is good, unemployment's really low, risk assets hitting high, we've got some momentum out there, then the Fed just starts cutting rates, saying that they're trying to get in front of a recession and ensure it doesn't happen. Then what's going to happen to all that $6 trillion in money market funds at record levels? It's going to start earning less yield. That could cause the mother of all FOMO trades into the stock market. And then, like I said, it becomes too much of a good thing and causes inflation to go back up. The Fed will do its best to keep rates low going into November election to try and get Biden re-elected. And then maybe if we see that higher oil, higher CPI above 4%, then the Fed has to do a big about face and start jacking rates up, which would be convenient for all of them to do that after the election and going into 2025. That's just one theory I'm speculating could happen this year in markets. We'll just have to wait and see. Moving on today to the biggest story from financial markets over the last 24 hours. And that was the long-awaited approval from the Securities and Exchange Commission of spot Bitcoin ETFs. Just started trading on the exchanges today after a lot of drama back and forth. Gary Gensler, the chairman of SEC, been fighting Bitcoin, and the industry ended up winning out in the end, conveniently after they drowned out the two biggest players, Binance and FTX. Now Wall Street's in there and they're going to control what's going on. And so now Bitcoin, which was built on decentralization, has now kind of become centralized and regulated on a US exchange, and in theory opens the doors for institutional money, and anyone can add it into their portfolios now. There's a look at the top 10 Bitcoin ETFs that started trading today, and there's a look at their fees, with 6 of them waiving fees for the first 6 months to try and track capital. And the biggest one that I'm going to track on this channel going forward, the most liquid, is that from BlackRock, the largest asset manager in the world, and their iShares Bitcoin Trust, under the ticker IBIT. There's a look at the first daily candle, traded 37 million units. There's a look at the 5-minute chart today. Opened for trading at $27.91, shot up right away to $30. So a lot of people rushed to get in, then actually fell over. Going into lunch, then just kind of traded sideways and finished near the lows for the day. And just looking at the price of Bitcoin itself, going down to a 5-minute chart, it too shot up into US market open. Did a great job of making all those fresh new investors pay up and then just fell over straight away. Just taking you out to a clean monthly chart. Still got a ways to go before it goes to all-time highs, which is 69,000. And looking at the biggest crypto exchange in the States now, Coinbase actually gapped up 6% to start the day. Then we finished down 6.7% on huge volume, 31.5 million shares. Now trading underneath its 50-day VWAP for the first time since October. So we've got a lot of Wall Street in Bitcoin now, and anyone can buy it, but not all the biggest asset managers are getting behind it. And that's the second largest asset manager in the world, Vanguard. It's not allowing its customers to buy Bitcoin ETFs. And they said it doesn't view crypto as part of a well-balanced investment portfolio. And that's in stark difference to their biggest competitor, BlackRock, which, like I just showed you, already has the biggest and most liquid Bitcoin ETF. So Vanguard has no plans to offer a Vanguard Bitcoin ETFs or other crypto-related products. As they said, these products do not align with their focus on asset classes such as equities, bonds, and cash, which Vanguard views as the building blocks of a well-balanced long-term investment portfolio. So one of the two big asset houses is going to be right. Vanguard could be doing their customers a favor, which we won't know for at least a year or so. Or if Bitcoin keeps ripping up and it does break 100,000 a coin, which a lot of crypto bulls say is inevitable, then Vanguard might have to FOMO themselves and then could possibly get pulled in at the worst moment. Either way, it'll be interesting to see whether they stick to their position here on crypto. And just looking at the statement of SEC Chair Gary Gensler, kind of reluctantly approving it and going along with it. But interestingly enough, he finishes on by saying, though we're merit neutral, I'd note that the underlying assets in the metals exchange traded products have consumer and industrial uses. While in contrast, Bitcoin is primarily a speculative, volatile asset that's also used for illicit activity, including ransomware, money laundering, sanction evasion, and terrorist financing. While we approved the listing and trading of certain spot Bitcoin ETP shares today, we did not approve or endorse Bitcoin. Investors should remain cautious about the myriad risks associated with Bitcoin and products whose value is tied to crypto. So not exactly a ringing endorsement of it, and coming across more as just bowing to industry pressure and going along with it with a lot of disclaimers. And so up next, the industry will be looking for the second biggest crypto to get an ETF, Ethereum. Then after that, maybe Solana. And we're seeing that in the price action of Ethereum, having a better performance these last couple of days than Bitcoin breaking out. And so it'll be interesting to see whether we get some Ethereum and other crypto ETFs come along as well. Either way, it's being legitimized and anybody can safely invest in Bitcoin now. And it's just kind of funny to see that the product was built of being decentralized and kind of being your own bank by holding it in cold storage and nobody else having control or influence over it. But that's exactly what a Bitcoin ETF is. You've got someone else as custodian over your coins, and you've just got to trust them and hope that they do the right thing by you and nothing happens to them. So you've got third-party risk now, which was the whole point of Bitcoin all along, was that you don't have third-party risk. So it'll be interesting to see how this all unfolds and what happens to the price of Bitcoin over the coming weeks and months. Currently has a market cap of 906 billion, with a total crypto market cap a little bit less than double at 1.72 trillion. Moving on, we got the US and China keeping a close eye on Taiwan as they're having an election this weekend to elect a new president, and that's a three-way race. And this could have consequences for the US-China conflict over Taiwan, as they're still a very important country and manufacturer of semiconductor chips. And just recently, as a couple of days ago, Chinese President Xi Jinping reinforced that Taiwan's reunification with China is inevitable and told Biden it's the most important and sensitive topic between the two countries. So we'll see what happens with that one, and I'll give you an update on that come next week. We also saw today briefly Microsoft become more valuable than Apple for the first time in many, many years. Microsoft was always the monster. In the 90s, going into the early 2000s, Apple was just a fraction of its size. And Bill Gates and Steve Jobs were always rivals, coming out of the same place in the 70s, getting into the computer industry. And it was nice to see just before Steve Jobs passed away in late 2011, Apple surpassed Microsoft as the most valuable company. And it's pretty much held it that whole time. But Microsoft's coming back as the monster in cloud and AI, and with their Office products, they have really dominant positions, still been able to grow at really good rates even though they're a huge business. And there's a look at the daily there, getting up to all-time highs above 390, whilst Apple's been a bit softer of late and is growing revenue at a much slower rate than Microsoft as well. Just looking at other economic data we got today, initial jobless claims came in a bit lower than expected, showing the jobs market still holding up. Get some inflation data out from China in a few hours. We expected more deflation going on there, and this could cause Beijing to come out with the mother of all stimulus packages soon to get underneath their economy. I think they want to really turn it around this year. Then finishing out the week tomorrow, got some GDP data coming out from the United Kingdom. Expected to be pretty soft. Inflation data from France and purchasing price index data from the States. Fear and greed index still elevated at 72, and corporate insiders still not doing much buying of their own stock at these levels. Breadth is still a little soft in the market. Only 273 stocks and ETFs breaking out to 52-week highs, and 87 breaking down to 52-week lows. VIX still super low at 12.4, and option dealers think the good time's going to keep on rolling, only asking for 1.48 points of premium above realized. TLT is looking to hold its 50-day VWAP there, and high yield bonds still performing better. Just shows the risk on sentiment in the markets. Also helping it is a soft dollar at 102. There's a look at crude being flatlining around $72 a barrel here. I'd say it's a bit of a tug of war between what's going on in the Middle East with those flare-ups and just the oversupply in the market and soft demand out of major economies. A little softer in international stock markets. This Thursday session, Japan Nikkei having a good week. Got the 10-year, 2-year inverted bond yield curve climbing back up to neutral zone, and inflation expectations didn't really tick up too much on that CPI report. Best performing stock sector today was semiconductors. Worst performing again today was the volatile clean energy sector, down 2.32%. And just taking you out to a monthly chart on this ETF clean energy PBW, that's down a massive 81% from its peak in early 2021. It's got a dividend yield of over 4%. I think clean energy is a bit of a contrarian play for this year as well. And since it's been sold off so hard, we may get a meaningful bounce. Also weak today was the utility sector, closing down below its 50-day VWAP. Health stocks are still holding up really good out of the defensive bunch, and it looks like we may be getting dividend stocks turning back down. Looking at my ETF picks this year, cannabis had a bit of a bump up today. Looking at the MAG 7, NVDA broke out to new all-time highs today, above 550, and a bit of weakness in Tesla, sitting at the bottom of the support zone after that news of Hertz abandoning EV vehicles in their fleet. But we do have signs of technically oversold here and could make for a good risk-reward long here. Being able to use a tight stop and maybe a bit of a bounce back to the 50-day VWAP. Boeing's been falling this week on more problems with their aircrafts. We've got Pfizer pulling back to its 50-day VWAP. I think it found a bottom here back in 13th of December. If you remember back on my daily show, said it put in a huge hammer candle on volume. It's really cheap. I think big value buyers were stepping in down there, which I think is a good long-term levels. It was offering over 6% dividend yield. Alibaba as well, looking to hold the support zone around $71 a share. And we've got the telecoms falling today as the EPA agency plans to hold meetings with AT&T and Verizon over the lead cables. That was the controversy that caused their big falls back in July, down to those really cheap levels. And these stocks as well, offering big dividend yields above 6%. And we'll be looking out to bank earnings tomorrow from the big guys, Bank of America, Citigroup, Wells Fargo, and JP Morgan, kicking off earnings season like they always do. And they've been on quite the tear lately. And so we'll be having a look at their results and forward guidance for a bit of a read on the economy and consumer. So there we are, just below all-time highs on the S&P 500. Market did sell off a bit in the morning after we got the CPI report. However, it found support and rallied right back up, and bonds actually fell, and Fed fund futures actually increased their chances the Fed's going to cut in March. And with the VIX super low, sitting at all-time highs, barring any big surprise, we should be breaking out tomorrow, if not next week. Unless commentary from the banks tomorrow really upset things. The momentum, trend and direction in the market is up, and until we get a close below the 50-day VWAP, we're likely to see higher prices. That's all I got for you today, guys. Thanks very much for tuning into my show. Appreciate everyone who hits the like button, and I hope to see you all again tomorrow for the last trading day of the week. Take care.